Learnings for 60 minutes on end. It's our third installment of the Tiger Stock series, brought to you by Tiger Brokers Australia. Don't forget, if you haven't already signed up, you can do that. And I'll share the link in just a moment, but you can get some goodies just for signing up. And also, just by creating an account through the unique link and funding your account, there are terms and conditions, of course. You can go in the draw to win $500 each and every week, thanks to Tiger. The first week's winner was Michael. Second week's winner, as in this week, I'm pleased to announce, is Chad. So, Chad, if you're watching, listening, wherever you're getting this, you are the winner this week. So, $500 will be automatically added to your Tiger Brokers account. It's as simple as that. So, well done to you, my friend. I apologize for being slightly late. I was doing some prep for one of the companies today, which is National Australia Bank, and sure enough, my spreadsheet decided to crash at exactly the moment when we were going to go live. So I finally got that over the line, and I think the reason that it crashed is because there was so much data on the banks, which I'm going to show you how to research, that it just couldn't handle it. So we got there in the end, and I got a snippet of the data, which I'll share with you in just a moment. But just before we begin, of course, everyone basically knows. I know Deepak's in the chat already. He would have heard this one before, but anything that I deliver today is limited to general financial information only. It's issued by the Rask Group. The reason why it's general is because it's not personal. I don't know your personal circumstances, needs, goals, or objectives. So before you invest, before you act on the information that you hear or view today, please speak to a licensed and trusted financial planner who can take into account your needs, goals, objectives, and your risk profile to help you make informed decisions. You can read the Rask Group's financial services guide at www.rask.com.au/FSG. That's as simple as it is. And we're not really going to talk about ETFs or managed funds or superannuation today, but if for whatever reason I do mention something like that, it's important to keep in mind that those also have product disclosure statements, or PDSs, and target market determinations, TMDs. TMDs and PDSs are available on the issuer's website. Okay, now that we've got through that mouthful, let's crack on, shall we? And as always, I'm going to share a few different tabs with you. I've actually got multiple windows open this week because we do have a few different things to go over. So I'm just going to make sure that I share the correct one with you today to start off with. Okay, I've got this one right here. And if I don't share the correct one and you think I'm going crazy, I probably am going crazy, but there's also a chance that I'm not, in which case just send me a message in the chat and say, hey, Owen, you missed this, or you didn't share the right screen. So as always, Tiger Stocks brought to you by Tiger Brokers. Listed on the NASDAQ is the parent company, also acts under an Australian financial services license here in Australia. You can go in the draw to win $500, but also just heaps of goodies, as you'll see on the screen right here in front of you. Over 4 weeks, we're covering, we're flip-flopping between Australia, the USA, Australia, and we'll be ending next week in the USA. Today's session is about the ASX darling stocks, and I've chosen 4, and probably the only one that's not a darling from the group is NAB. That said, it is a darling in terms of dividends. I think I shared in the email today that it's around about an 8 or 9% grossed up dividend yield. So if you include those generous franking credits, you get to about an 8 or a 9% yield, which is pretty compelling for folks, especially those that are eligible for franking credits and in return. So we'll be looking at NAB WiseTech, which is the global software business that helps logistics companies all around the world. We'll look at Altium, which is a software company for engineers and electronics designers. And then we're going to jump into ARB, which is this business right here. You've probably seen this logo on 4x4s or four-wheel drives right around the country. ARB is indeed Australia's #1 bull bar accessories business. So if you've got a four-wheel drive, if you know friends who have a four-wheel drive or an SUV, have a look on their car and see if you see this logo anywhere on there. Okay, so like I said, we'll be focusing on company fundamentals. We'll look at the industry dynamics behind these businesses. We'll focus on long-term investing. That's what we do at Rask. They are compounders, so we're focused on that. Just as always, every week I do say that even though we're focusing on companies this week, a big part of my portfolio and indeed the entire Rask networks community of investors focus on ETF or exchange-traded funds, and even to an extent managed funds and property. and then we focus on direct stocks. So what does that look like? Like how do we invest for the future? Well, basically we have this core portfolio that's built out of ETFs, and then we have satellites around the outside, which might be higher risk investments, individual stocks, that type of stuff. Maybe some more of those things that are a bit more, as someone more literary than myself might say, is a bit more esoteric. And those are those things that go around the outside. Okay, so I will just, actually, I'm just going to be back in 1 second. I haven't done this before. I'm just going to close the door. There we go. That's a bit more quiet for everyone. Pardon me. So today we'll be covering these four companies. We've got ARB, WiseTech, NAB, and Altium. I do not own shares in any of these companies at the moment, but that could change at very short notice because I like all of the businesses for one reason or another. So Mike, you've said kind of early for me. Yeah, it is a bit early for me, isn't it? So Mike, you said my preamble about Tiger was truncated. Okay, Mike. So if you or anyone listening to this decide to join Tiger, through this link, which I'll pop in here now. Actually, it's a good response. So I'll just pop this in here now. There's a link in there that says that's the link to join. It's obviously not me giving personal advice, just so you know. We don't earn anything from anyone signing up necessarily, although this is a series sponsored by Tiger. There are some goodies up for grabs if anyone creates an account, but also go in the draw to win $500 if they are selected and if they meet the terms and conditions, of course. So that's there. So Deepak, you said you were listening to the AFP episode with Kate this morning where you said you were going to read Atomic Habits this summer, and you also listened to books on Audible. You recommend reading or listening to audiobooks? ? Yeah, so I listen to a lot of audiobooks. Just so you know, Deepak, I do indeed. I listen to basically any author that comes on one of our podcast. I will either read the book or at the very least I will listen to their audiobook. And that's just because it's a good way to consume information on the go, as well as listen to their podcast, frankly. Okay, good. Glad to hear you got that, Mike. So this is how it all works. All the information is available on this page on how to get started with Tiger and what's included and all that sort of stuff. Okay, so before we get into the companies, just really quickly, one of the things that was missing, and it was deliberately missed over the last few weeks in the Tiger Stock series. Last week, I think there was a comment on the video, which people can watch back at any time, and it basically talked about valuations of companies. So one of the things that we've done so far in the series is we've scored companies based on their quality. There is a little line item here. I'll zoom in a bit. There is a line item here that scores companies based on a reasonable price. So obviously you can't just go out and buy the best sounding or the highest quality companies in the world and think that that's going to be perfect as an investment strategy. It might work. I'm not going to say, I'm not here to say it won't work, but if you just bought all of the companies that sound great, what you might end up with is a very expensive investment portfolio that is extremely volatile. And as a result, you might not actually outperform the stock market. So one of the filters that you've kind of got to do is you've got to talk about valuation. You've got to have a sense of, am I overpaying for this company's shares? Is it good value? And I think what happens is every one of us here today can basically look at a company and we can go, it seems like it's pretty good. Like it's got good culture. It's got the right culture for the business. The profit margins are pretty good. It's got a high return on invested capital, as we've been talking about. Its sales are growing. Now, these types of things, and we can say, with maybe, a few months of kind of looking at this stuff or a couple of years, you can say with conviction, I think it's a really good company. And I think it makes good profits and it's going to make more profit in the future. But the thing where everyone gets tripped up, and I think when I say everyone, I also mean professionals. In my experience, interviewing hundreds of the country's best investors, CEOs, even global capital allocators and people that are internationally recognized as being professional investors, what I've realized is that people spend far too long on valuation, absolutely far too long on valuation, and they dramatically overcomplicate this part of the process. So today, I want to talk to you about probably the most eloquent and simple and effective way that I've seen people do valuations of business. The problem with this technique that I'm going to talk to you about is that it does require you to have experience understanding companies and understanding market cycles. So you need to understand how valuation works. You need to understand how businesses operate before you can use this technique. But I think once you understand those things and you've applied yourselves, it actually is the most effective way to value an investment opportunity that I've come across. Um, and the reason that I'm bringing this up in the third week here on the show is because we needed some sample, i.e., we needed to run through the checklist for a number of companies before I could show you how this valuation is approached. So I'm just going to flick back here, but let's just introduce people to what is valuation. So valuation is this idea of you buy something for less than it's worth. And the kind of the anecdote or the kind of example that I give to you is just imagine like a pair of Nike shoes. You walk into the store, I'm walking in with you, and we see a pair of Nike shoes and they're $200. And I go, oh, that's pretty expensive. I don't think they're worth that much. So you see the price of the Nike shoes is $200. Everyone can see the price. That's just like the stock price, right? Everyone can see the price. Right? It is known. There's no secret about that. You can view the stock price in your Tiger account on Google, wherever you get your broking. But the thing that you can't determine straight away is the value. Now, in the case of Nike shoes, what you have is you have a pair of shoes that you have to independently value. So I could put a value on Nike shoes just using my head. I could be like, well, I'm not prepared to pay $200, but maybe I'm prepared to pay $50. And so if I'm prepared to pay $50, if the current price is $200, I think they're overvalued. But you might say, well, hey, Owen, I actually really love those shoes, and I think they're going to get more valuable in the future than you think. And you would say to me, I think they're undervalued because I think they're worth $300. And so this is the idea of valuation. It's part art and it's part science. But people think either it's one or the other. They think it's all art or it's all science. If I was to guess, I would say it's probably slightly more art than it is science. And that's what I'm going to show you today. And so this is an example here. You'll see a stock price chart going up and down in this dark white line, and then you'll see the valuations like this. And the Strawman platform in Australia actually visualizes it this way. You can actually see people's valuations looking like this. But basically what I tried to illustrate in this chart here is that when you look at this, you'll notice that the actual price doesn't the valuation, doesn't change as much as the price does. So whereas the price can fluctuate up and down every day and normally will, the valuation that you put on a company or you put on some shares doesn't change as often. So you can see, like say for example, if I went out and did a valuation of Altium, which is a company we're going to talk about today, and indeed I have done this, I realized that over the last 4 or 5 years that I've done my valuations, that actually, you know what? My valuations don't change that often. I probably update them once a year, whereas the stock price is bouncing around 250 times a year, right? And so valuation doesn't change as much, but it does change over time. And I think the key thing to understand here is that when you let the stock price dictate how you invest, I think you are going to lose. That's my belief. I think value investing is hard enough, but if you react to what a stock price is doing in a way that is emotional, you're going to lose. I just think that that's not a very sensible way to be a long-term investor, because you've got to know what the business is actually worth. All the stock price does is it shows you or gives you an entry and an exit point. That's really all it does. But what happens in between doesn't really matter too much, because you know the value of the business will eventually be the driver of the returns. So when we do valuation, there are a few different tools that we use. We use multiples. They rely on forecasts. We use things like sum of the parts. So that's supposed to say sum of the parts. So sum of the parts is where you get the different parts of a business. You add it all together, and what's the valuation? You can value a company based on its dividends, which we'll do today. You can value it based on cash flows. It's sometimes called free cash flow. It's not the same as profit, although it is similar. It's not the same as profit. It's the actual cash flow of a business. And finally, you can value a business based on private market valuations. And what I mean by this is normally what happens in the stock market is analysts will use something called a discounted cash flow analysis. And discounted cash flow analysis is Basically where, and I'll just draw it on the screen really quickly. Basically a discounted cash flow analysis is we say in the next 3 years, in this example, you might have 10 years. You say in the next 3 years, what is the value of this cash flow, and this cash flow in today's dollars? Like if we took all of these cash flows and we put it into today's price, what's the price? That's what a discounted cash flow analysis is. Now, the problem with the discounted cash flow analysis for anyone that's done one is that when you do one, it's like you're looking through binoculars or it's like you're looking through a telescope. If you look straight out of a telescope long into the distance, like let's say you look at the stars, you might be over here looking at, say, our sun at the center of our solar system. But if you pivot just even a tiny bit, right? If you change the inputs of the DCF even a tiny bit, all of a sudden, you're not looking at our sun, you're looking at Pluto. You're looking at a completely different galaxy, right? And so basically what happens here is that a DCF is very, very, very sensitive to the inputs that you make. So one false move and you're wrong. You're completely way off. And that's why we always say you're better off being generally correct than specifically right. So even if you make a mistake, you're still in the ballpark. If you, for example, put in the wrong input or we make an incorrect forecast, you're still in the ballpark of where you want to be. You know the valuation's over here somewhere, but you're not being too arrogant to say, I know exactly what it's worth, which is what basically all of the stock market does. The reason this is important is because of this one fundamental truth, which is that if you invest for 10 years, right? If you invest for 10 years in the top performing companies, the data suggests that the number one thing that matters, this blue shaded area right here, the number one thing that matters is the profits and the sales growth of that company. Think about it. If you were investing for 10 years and in 10 years' time your company didn't grow, it's probably not going to be worth even what it is today. But if it grew at even 10% a year, increased its sales by 10% a year for 10 years, it's more than doubled its sales. But then at year 10, people would probably go, this company's got a really good track record. I'm going to value it more highly than 10 years ago. And so this effectively feeds on itself in that the longer you invest, and you can see this here, the longer you invest, the more share that focusing on the fundamentals or like the sales of a company matters. And the less things like the price to earnings ratio, which is this bit here, matter, and the less the profit margins matter, and the less the free cash flow of today matter. The number one thing that long-term investors should be focusing on is a company that can grow and improve its profitability. In other words, if you use the price earnings ratio or some type of, really simple kind of like, well, it's overvalued because the dividend yield is low or something like this, you're basically fishing in this part of the kind of equation. And the longer you plan to invest, the less relevant that becomes. Conversely, if you can identify a company that will grow and grow and grow, the better your investment outcomes on average will be. You still get it wrong no matter what you do. And this is what makes stock picking in individual companies so damn difficult, is that there are so many forces at play, not just one. There's the profit margins, there are the free cash flow, there's the multiple or the price, multiple, like I'm going to pay 10 times price earnings, I'm going to pay 20 times price earnings. But at the end of the day, to tilt the odds in your favor, if you are a long-term investor, is sales and profit. This is a Boston Consulting Group report that you can Google online. Okay, so now that we know how we're going to do it, this is the simple connect the dots. Now that we've scored our companies, and now that we know that long-term growth is the key thing that we want to find, it's actually a pretty straightforward thing. Once we've done a score, once we've scored companies, now this is obviously a very brief checklist. I think I've said before to you that at Rask, our checklist for companies actually has, I think, 100 points on it. So 100, we give companies a score out of 100. I think there's 45 different questions. Whereas with this, and that's only the initial research, whereas this one only has a few and it's really quick for us. So you'd want to build this out. But basically, once a company has a score like this, what we can basically say is the companies that have the highest score, or this is just based on fundamentals, The company that has the highest fundamental score is the highest quality. And the highest quality typically means a company that can grow for a long time. Because if it's like say Microsoft, there's a question about this. If Microsoft has a really high score, basically what it's suggesting is that we as an investment community are saying Microsoft is capable of growing for a long time because it's got a defensive business model, it's got good management, it's got strong profits and cash flow, it's growing, etc. Therefore, it deserves to have a higher valuation today. And so let's take, for example, I don't know, let's go to just quickly beta shares NDQ. So this is the NASDAQ 100 ETF from beta shares. Now, if you look at, where is it? This fact sheet, I think it is. So if you look down the side here on the right-hand side, you'll see that this ETF that just tracks the NASDAQ 100, the top 100 companies on the NASDAQ stock exchange in the United States, you'll see that the price earnings ratio of the average company inside of that is 22 times. So the price earnings ratio on the average company in this index, 22 times. 22 times price earnings ratio. So my question to you right now is, if you care to put your answer in the chat, the live chat, is if the average is 22 times price earnings ratio for the top 100 companies, what would be a fair price to pay? Like, what would be a price earnings ratio that is fair to pay for something like Microsoft? Like, what would you pay? Would you pay more than the average because it's a higher quality company, or would you pay less? Like, what price would you say is reasonable? Now, while you think about that, I can say to you that this method that I'm talking about right here, once you research a company and you compare it to what you've got available to invest in, this method here is actually used by some of the most successful investors I've ever met. And that is kind of the key thing here, is like using your understanding of the business and spending less time on valuation is the most important thing. Tarwin, you said, what are your thoughts on using earnings per share year-over-year growth as an initial screen for future valuation? Yeah, I don't mind it, Tarwin. I don't mind looking at the per share profits and looking into the future, but at the same time, it's not perfect. I like to do my own, even though I use this method to invest today, I still do my own, I still do my own modeling and stuff like that. This is from Ticker, but I still do all of this type of thing myself, no matter what. I don't rely on analysts to do it, because my belief is that my only value that I can add as a long-term investor in individual companies is to understand the businesses really, really, really well and identify the long-term growth drivers of each business. That's how I do it. Now I'm going to cut to the chase here. If the average company in the United States trades for a price earnings ratio of 22 times, I would be willing to pay more for Microsoft shares. So I would be willing to pay something like 25, maybe even 30 times earnings, because I simply think it's better than average. It's so much better than average because it's got such a high score. But if you gave me, say, Qantas, right, in Australia, and let's say, for example, I don't know what it is of the ASX 200. Let's say the average price earnings ratio of the ASX 200 is, say, 14 times. Because Qantas is such a low quality company, in my opinion, I would be prepared to pay maybe 3 times price earnings ratio. That's probably what I would be prepared to pay for a company that's such low quality, right? And this just gives you a sense of like how you can use the price earnings ratio, price to sales ratio to actually base your kind of decision making or the reasonable price on the quality of a company, which we know is the only thing that really matters. Not like the short-term technical analysis, not like the trading. Like that might work for some people, but I haven't seen it work at scale. And I think what I've seen work is people who can focus on this first bit and get the company right first, then let this little valuation thing guide when they enter or exit. So I would pay more for a growing, profitable company. Can it grow into a higher PE? That's the thing, Tarwin, you're right. I can spend more time on that another time, but you're spot on, mate. So I would say the same thing. You want a company that has growing sales, but also an increasing price earnings ratio or increasing profit margin. And there's a way to do that. Okay, so let's cut to the chase. Let's get into these companies. So I'm going to, and this is why I only use ETFs. Yeah, Mike, that's fair enough. Most people choose to only use ETFs, but like a lot of people are curious about individual companies. And so they do use individual stocks as a very small component of their portfolio. And this is kind of what I do, is I use it as a small component of my portfolio to make sure that, I'm kind of scratching the curiosity and I can still learn about business and it keeps my interest there. Okay, let's jump into the Tiger platform really quickly. I'll bring it up here on the screen. There we go. So here we can see we're in the Tiger platform. Many of you know this from last week. You can find a company. Let's say we're going to look at Altium. So Altium is the Australian printed circuit board company. So remember, you can click this material tab at the top here, and you can't see it because it's just open in a new tab, but it actually comes up with all of the key information about the company and the financials and these types of things. But what you can also see is a highlight of it down the right-hand side here. So you can see down the right-hand side, you can see like company news, you can see a bunch of different information in there. You can see a quick look at the financials. You can get a quick look. So here we can see about 23% of the company's profits revenue, came from its cloud platform and 77 from its core design software. So let's just break these two parts of the business down. Altium's design software, it's called Altium Designer, is kind of like me. I'm sitting here at my iMac. I'm recording this live today. You can see you can see the Tiger program here in front of me. You can see all of the buttons and the bells and the whistles and whatever. Imagine I just get access to Altium software, and I'm a software engineer. Instead of looking at financial charts, I'm looking at printed circuit boards or what the inside of an iPhone looks like. And I'm designing things and I'm making sure that there's enough transistors and there's enough circuitry on that board to make the iPhone work with the new CPU I want to put in. I would design that here and I would pay a subscription to Altium. It's that simple. And I'll show you how much they pay in a moment. That's Altium Designer. Altium Cloud Platform is effectively the same thing, except it's all in the cloud and it connects with other tools. So for example, it could connect to a search engine, which they call Octopart. It could connect to a manufacturing company. So say I want to build this new iPhone, but I don't want to have to export the designs and then kind of print them off and then send them down to China or something like that. I can literally connect straight to the manufacturing floor and have the thing built. And I can connect straight to the search engine for all the little components that I need to put on my printed circuit board or in my new iPhone and send it off to the manufacturer. That's literally how it connects. So one of the things that we've been looking at recently is return on capital, ROIC. And so here we can see Altium's return on capital has been very consistent through time at about 18%, which is great. That's what we want to see because that shows that it has a defensive moat. We can see total revenue growth over time through here. It's been very, very consistent. The one time it wasn't consistent was during COVID and it got sold off heavily as a share price. And so overall, a very high quality company because it's growing fast. It's got a high return on capital. It's got dominant software business with wide profit margins. So if we go in here, actually, if we go down to and we look at, it doesn't show it here exactly, but effectively, Altium has a lot of cash on its balance sheet. So I'll quickly share that with you now. I'll bring that up. I think this is the one that I want. Okay, I've got it now. And where are we? Where are you, Owen? Where did I put my other tab? Sorry, guys. Here we go. Got it. Okay, so this is for ARB. We want to go back to Altium really quickly, and then we'll give it a score. So here we can see the Altium presentation most recently. We can see revenue, and we can see this kind of like stacking chart, this waterfall chart. We can see that the cloud platform in this blue area is growing, but it's still a smaller part of the overall pie. We can see more people are clicking on the Octopart search engine results to put the components onto their printed circuit boards. We can see the number of accounts that are migrating and the number of users on the platform. Everything is pushing in the right direction. But at the end of the day, for a software business, You need to know how it makes money. Altium makes money through the number of subscriptions, but also the subscription price. It's like if you have, let's say in your household, you have Netflix, you have Disney, you have Amazon Prime, and you have Stan. These are the streaming services that you watch on your smart TV at any one time. Well, everyone knows that the price of Netflix has gone up recently. Everyone knows that the price of Disney has gone up, Amazon has gone up, Stan has gone up, right? Everything has gone up in price. Normally what happens in that environment, in your household, you would get rid of one of those pieces of software, one of those subscriptions. Now, you'd probably cut the one that you use the least. You'd probably cut the one that doesn't have as good as shows, and you just keep the one or two that is really good. At least that's what I've done. So at the end of the day, what you need to know for subscription businesses and how to analyze them is how many subscribers are there and how much do they pay? And then if they increase their prices, how many people leave? So how many people, if I was to put up the price of Netflix, I say I'm the person who runs Netflix, I put up the price of a Netflix subscription 100%. It's now $70 a month. How many people would leave? I'd say a lot. So it doesn't have that much pricing power. Here with Altium, you can see that the price of the subscriptions has gone up quite dramatically over the recent few years. And that is obviously what's helping to drive revenue up 19%, as well as the number of accounts. So more people using it and it's going up in price. And the reason this is happening is because Altium has this very bold target, if you ask me, to transform and dominate the printed circuit board design industry. So this like connected manufacturing industry, Internet of Things. And you can see that they've got this target, which is $500 million of revenue with a very strong profit margin. And they say most of it's going to come from design. But by then, in just 2 to 3 years, the cloud platform is effectively going to go from 65 to 70 million to 150 million. And they say down in the footnote down here, with the stronger uptake of the higher value subscriptions, the $500 million target will be reached with only 75 to 90,000 seats on subscription. Even though they're targeting 100,000, they're saying we only need about 75 to 90,000 because we're increasing prices. And so that's basically the beauty of this business. If it can increase prices and attract more engineers and designers, it's going to meet its target. Now, the other things that we look at, and I'll just bring those across into this one centralized place now that I've done that. So I'll drop this in here. I'll bring this across. I'll bring this across. I'll bring this across and get rid of that one. So now that we've got the other things so we know that it's growing, it's got a big growth opportunity in front of it. It's not the only one. It competes against like Cadence Systems and a few others, Autodesk and Mentor Graphics from Siemens. But the sales opportunity is very strong for Altium. So I would say it's probably like an 8. Remember that we're not comparing, when we score these companies, even though I say Altium is an 8, it doesn't mean that it's better than Apple's growth prospects. We're comparing the companies as if we're only comparing Australia and we're only comparing US to US. So don't compare Altium's 8 to Costco's 6. Compare Altium's 8 to Qantas's 5. Like Qantas is not a growth company, but Altium is probably like an 8.5 if you compared it to Qantas and Flight Centre. It's growing, it's global, it's a good business. Is it a defensive business model? Yes, it's got very low levels of customer churn, even though it's increasing prices. So I would say it's a defensive business, even though it's a tech business. Like it'll be volatile. The share price will bounce all over the place. Like if you one of the great things about Altium is that it is so volatile. The share price just dramatically rises and falls. And that's what gives you, the individual investor, an opportunity to buy the business and buy shares when it's not that overvalued. Is it a business you can understand? I think it's quite technical, and that's probably one of the reasons it gets sold off. But I would say for most people, if they put in the work, they can understand what it does. I think the company uses far too many, I'll probably go 6.5. I think the company uses far too many catchphrases and buzzwords and lots of ridiculous charts and graphs and stuff like that, when it could just say, here's what we do and here's how we're winning, and it'll be done. That's literally it. I don't think they need to explain the business. I don't think they need a 51-page presentation to do that. So I'd say it's a business you can understand, but I actually think they by doing so much, they actually take away from the core product and the core people's understanding of the business. So is it an aligned management team? Absolutely. It's got a fantastic management team. Despite what I just said about them being very promotional, I think it's actually got one of the best management teams in the country. So I'll go 4.5 out of 5. I think maybe 4.5. That's reasonable. CEO Aram, he's been with the company for a very long time. He took a brief stint somewhere else, transitioning to a new chairman. But at the end of the day, the business is very well managed with lots of people that own, hundreds of millions of dollars of shares. So they're not going to let it go down. They're going to keep innovating and doing well. Does it have strong profit and cash flow? Yes. If we go to, where did I put the annual report before? Yes, here we go. If we go to, we can see very strong profitability. We saw the profit margins before. We can see it right there. And if we go to the cash flow statement, we can see strong cash flow. Remember, if we take the cash flow from operations, and we subtract the investing cash flows, that's a very quick and easy proxy for free cash flow, the thing that all the analysts talk about. And you can see 55 million minus 3.6 million means it's still generating positive free cash flow of around about $52 million. So it's still ticking forward. That's why it's got a good cash balance and so on and so forth. So out of 10, I'd give it an 8. Is it a reasonable price? Well, this is the thing we might need a bit of help with. So we'll just jump into ticker here. We could look at the price earnings ratio and all that inside Tiger, but I'm just going to bring this in here. I'm going to go to the valuation section. And I'll wait for that to load. And there we go. And here we can see, that's next 12 months. Get rid of that. I want last 12 months price earnings ratio, this one right here. So this is the price earnings ratio over time. And you can see here that it's probably averaged around about 50 times price earnings ratio, which is huge. 50 times price earnings ratio. Now, I've done a full discounted cash flow on this business, so I kind of have an indication of where the valuation is at. And it's in the high $30. So I wouldn't say it's overvalued like dramatically, but I'd say it's probably fair valued. So I'll give it, say, a 3. I would be looking, if this company ever dropped, you can see how high quality it is. It beats all the companies we looked at in week 1. If Altium was dropping in price like it did a few months ago, I was actually going to buy it. This day is the day that I was going to buy it. And then it jumped like 30% in one day because it came out with results. I would buy it in the mid $30 range for sure. I think it's a good business. Tarwin, you did have a question. Do you consider the price earnings ratios of the top 10 underlying stocks in an ETF? Can it be over or undervalued? Nah, Tarwin, I don't. I think the reason that most people invest in ETFs is not to time the market. Some people might say they do, but I think the reason people invest in ETFs is because they just have this dollar cost averaging. I'm always investing. It's part of my habit. It's part of my routine. I think that's a much better way to approach investing in an ETF rather than, trying to time it by having low price earnings ratios. However, Tarwin, what I would say is that for thematic ETFs, you have to be very careful. So in a thematic ETF, where it's say like a technology ETF or an artificial intelligence ETF or a cybersecurity ETF or a robotics ETF or something like that, absolutely be very mindful of the valuations of the companies inside. Like for those thematic ETFs, you have to look inside. If you don't look inside, you have no idea what you're buying. Whereas if it's say like Vanguard VAS or BetaShares A200 or Global X N100 or iShares IOZ, like one of those type of really low cost, boring ETFs that's just doing the same thing each and every month, I don't look at the price earnings ratio, to be honest. Like we do for the members who invest with us, we do. Like our team looks at it, but it would only be a couple times a year just to reassess the portfolios and check in every quarter. But at the end of the day, what you're doing is you should spend more of your time focusing on, well, how are the currencies moving? How are the companies inside the market? How are they performing over the next 5 to 10 years, not next 1 to 2 years, which is the price earnings ratio? I hope that makes sense. A bit of a wishy-washy answer. Altium, great business. Let's move on to WiseTech. So WiseTech creates software for logistics companies. So not that one. I keep on getting them all mixed around. What is this? That is not what I want. So WiseTech creates software for logistics companies. And many of you may know that I recently interviewed, and it was about a 2-hour interview, Richard White, WiseTech, Rask. I recently interviewed Richard White, and it was a 2-hour, nearly a 2-hour conversation. And I talked to him about all different types of things, about his backstory, how the business was formed, what it goes through, etc. If you haven't already listened to it, that is the thing that's the only thing that could go close to doing justice of what went into creating this company. But this business sells its software, and predominantly that software is sold to logistics companies that need to ship stuff around the world, or that need to go through customs. Like if I order something from, for example, I ordered an automated chicken coop door from Germany the other day. That thing has to come from Germany, go through airports or through cargo shipping lines, and it has to be tracked. But not only that, customs officials have to be able to know where it is, and they have to be able to monitor things that are coming through. CargoWise, which is WiseTech software, helps logistics companies track, monitor, and optimize routes throughout the world. So it's used by companies that have to be in the logistics game. They're at the port, they're on the boat, they're in the air, they're on rail. These are the types of companies. And if you read the annual report, you'll come across that. It is a software business through and through, founded by Richard White, this guy right here, who still owns about the company off the top of my head, which is great for him because the company has performed exceptionally well. And basically, the business, what it does is it grows in two ways. One way, it kind of just keeps on finding customers and rolling out its software. The second way is it makes acquisitions of other companies that are in those markets. So say they need, I don't know, some customs company is a specialist in Rome, Italy, right? And they don't have a presence in Rome. So what they could do is they could try and build the software and find customers and work with the ports and work with this and work. No, what they'll do is they'll buy a company there that's smaller, that has the team, that has the know-how, and it will take that company and start integrating its software into that business over time until they're all on board the CargoWise platform. Now, many of you know this, and I've said this many, many times, is when you go into the annual report, search for something called the segment report. Remember, the segment report is how you can view the business based on what the management are looking at. And every company is supposed to do this in the annual report. It doesn't matter if they're US, Australian, European, whatever. And here we can see that the company this is the CargoWise business. And what CargoWise does is it charges based on basically usage of the platform. So the more shipping, the more logistics, the better it is for WiseTech, which is a wonderful business model. And you can see that down here. A large amount of revenue is generated by customers from transactions that cross multiple countries and where the source of the revenue can be unrelated to the location, blah, 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 blah. Basically, it's transactions on the platform. So that's this revenue here. However, they still have some clients that just take like bigger maintenance contracts, but they're slowly kind of phasing out. If they'll still have them going forward, but the bigger slice of the pie that's growing faster is this on-demand, pay-per-use kind of thing. And in the year ahead, WiseTech is forecasting that it will hit $1 billion of revenue. And at the very end of that interview with Richard White, he actually explains how big the market opportunity is, because logistics is probably one of the biggest things in the world when you think about it in terms of sending products around the world or just across your country. Amazon, the internet, manufacturing, literally everything needs some type of logistics to get from one place to another, or from one business to another, or from a business to a consumer. And so that's where WiseTech plays. And it is a wonderful platform that's deeply ingrained. So I hope that all makes sense. So growing sales opportunity, I'd give it a 9, probably even better than Altium. And in fact, yes, it is better than. Is it a defensive business model? 96% of revenue is recurring. I think off the top of my head last year, 99% of customers are retained. The business, you can understand, yes, it's just software for logistics companies. Management, yes, I'd give it a 5 out of 5. It's one of the most aligned management teams in Australia. Strong profit and cash flow. Let's have a quick look. We go back and we go up to, get this out of the way. We go up to, here we go. Cash flows. We've got remember what I said before? We've got the cash flows from operations. Oh, this is a good exercise here. So we've got the cash flow from operations. This is the cash from the actual business. And then we've got the investing cash flows. Now you'll be like, whoa, 870 million going out the door. That's because they made a huge acquisition. So you would exclude this figure from your calculation. In a free cash flow model, you'd take this figure effectively and you subtract probably just this one, but maybe this one as well, given that it looks like it's recurring from one year to the next. So very cash flow positive because it's got 380 million coming in and only about 140 going out. Very, very, very cash flow positive. So you would say, and we know it's super profitable. So you'd say maybe like an 8 as well. Is it at a reasonable price? This is the thing you always pay out for WiseTech. I've been saying it for years that it's been too expensive. But if you think about the opportunity for WiseTech into the future, which is enormous, it actually, if you have conviction in Richard White and his team after listening to that interview, you probably say, well, actually, you know what? I think it can keep growing. So price earnings ratio close to 100. That means you're paying 100 times annual profit, but it is in an early stage of growth. So I would say maybe 3, something like this. And I would say 40 out of 50 is not too bad. So that's pretty good. Tarwin, you said, can you comment on the growth by acquisition versus organic growth? How to judge if it's roll-up growth only? Great point. So one of the things that happens in a company like WiseTech, if it's making acquisitions, you just don't always know if indeed it is a business that I guess is only growing through acquisitions. I think you really need to understand the nature of acquisitions. So what I mean by that is some companies make acquisitions because they need growth. So what I mean by that is like they've got really poor management teams who only want to grow their business because they need the share price to grow up, and that's when they get their big bonuses. In the case of WiseTech, they're not buying that for the financial growth. What they're buying those businesses for is basically for operating synergies. So it's cheaper for them to buy a business in many instances that already has the team, that already has the relationships, that already has the know-how. Think about if you built your own software and you wanted to go to Rome in Italy and your software is in English and the customs is totally different over there, but you're trying to use your software in any case. That would be close to like impossible to start selling that software quickly. A quicker way would be to buy the company, use your software, get them to translate it, or get them to tell you how the system is different there than it is here, and do it that way. That's very different to say a company that buys other businesses. Like in Australia, a company like Dubba would be an example of a company that just buys businesses that says it's going to result in synergies, but has never materialized. And a way you can check all of this is just look at the profitability over time, Tarwin. So look at the per share profitability. So obviously, if you're making profits, you might make bigger profits if you make an acquisition in the dollar sense. So I might make $150 million of profit if I make the acquisition, or 100 if I don't. But if I have to use heaps of debt or have to sell more of my shares, then my per share profitability is going down. So you can see per share profitability is growing fast. And that's kind of one of the key insights and ways to check. Okay, so let's go to NAB really quick. So NAB makes its money. I know, you probably know, but it makes its money by selling loans effectively. So that's what it sells. You go to the bank, you get a loan. But the thing about NAB is it doesn't make most of its money from you and I going and opening a bank account. That's not how it works. NAB makes most of its money from lending to small businesses. Now, I've actually got 2 different companies. So some people know this, but some people don't. I actually run 2 different companies. And both of those companies bank with NAB because NAB is the best for business banking, in my opinion, in Australia. That's why it has won. That's why it has the biggest market share. And it has a different kind of advantage being in business banking. Typically, businesses are less price sensitive. So what I mean by that is, like, if you go and you look at your mortgage today, I got my stepdad to do this last night. If you look at your mortgage today and you're not getting an interest rate that's say 6.2 or 6.25% from your bank right now, if you looked at your mortgage and you looked at the interest rate and you're not getting that, you're probably getting ripped off. Just plain and simple. You're probably getting ripped off. If it's not 6.25% to 6.3%. However, in business banking, it's not really the way it works. A business owner doesn't just go to their bank statement and look at their rate and go, well, it's not as good as XYZ down the street. I'm going to switch. When you have a business relationship with a bank, it's very different because it's based on them looking at your business, helping you grow. It's more of a relationship. And so you want someone that does the thing that you need them to do from a banking perspective. But they need to understand your business. They need to help you get finance. They need to help you navigate cash flow issues. They need to help you get a card for your team. You need to be able to go in and actually just talk to someone who understands what company structure you're running. And that's very different to just here's a mortgage from the bank for your home. It's very different. So in that sense, ultimately what it means is a business bank can charge more to its customers than it could to a private individual. That said, NAB hasn't really been able to do that over the past 10 years because it's been really struggling. Like 10 years ago, NAB was almost just like it was brought to its knees. It was crippled because it did have a management team that tried to grow in the UK and tried to grow overseas. And it was a disaster following the global financial crisis. And that took a decade or more for them to kind of get out of that. And so they're only really now simplifying their business and focus on the long-term benefits of being in business banking. But you can see over time, since COVID, they've recovered their dividend. The business has continued to grow. The key competitor to NAB in business banking is now Commonwealth Bank. Commonwealth Bank didn't used to have as big of a presence in business banking, but it is slowly doing that. One of the key things you look at when you look at a bank, guys, is you look at the credit impairment charge. So this is the line that's on their profit and loss statement, and it tells you what they think they're not going to be able to recover for someone that got a loan from them. You would expect this to go up over time as interest rates go up and people struggle to pay their loans. Another thing that's different about a bank's income statement is that a bank has two different lines of income. It's got net interest income and it's got other income. This one is effectively showing you how much do they make from lending money. So they go and they say, for example, you put your term deposit in the bank, so they have to pay you interest. That's money going out. But then they have a home loan with they've issued a home loan to someone who's paying them a monthly interest on their home loan. That's money coming in. So the net bit is how much do I pay out versus how much do I get in. That's the difference. It's the net interest income, and it's sometimes expressed as a percentage of loans, which is called the net interest margin. The other thing here is like the services around the outside. So not so much anymore, but they used to have financial planning, insurance. They used to do managed funds and these types of things. Not so much anymore. The key aim of the game is net interest income or lending. And that ultimately results in a dividend. And the dividend is what you do a valuation of a bank share off. One final thing I wanted to show you is you can actually check the market share of a bank in Australia very, very easily. You go to the APRA website and you go to monthly authorized deposit taking institution statistics, and you download this thing right here. And it's updated every month, and it shows you how much the banks have as market share. And it looks like this, you can see if it's, for example, home loans. You can see if it's credit cards, they'll be in here somewhere. You can see short-term borrowings. You can see deposits. You can see a lot of different things in here, and you can actually use this to estimate who controls the credit card market, who controls the investment loan market in Australia for property, who controls the owner-occupiers like the homeowners, who controls to lending to businesses. And if we look, we can see ANZ currently has $137 billion of loans to businesses. And who else has got more than that? Why don't we go like this? We'll go format. We will go conditional formatting, and we will go color scale. We will go like this. We'll just go like that. Okay, and now we can see, so ANZ has 137 billion of loans to businesses. If we keep going down, who's this one? 182. That's Commonwealth Bank of Australia has $182 billion of loans. If we keep going down, 218, that's National Australia Bank. National Australia Bank has $218 billion of loans to businesses. Keep going down, Westpac at $150 billion. So you can see that NAB is the biggest business bank, but it's not the biggest when it comes to home loans. That's Commonwealth Bank, if that makes sense. So that's how you can check quickly and easily using APRA statistics. So if we go back to our checklist, let's zoom out a little bit. Growing sales opportunity, not really. It grows sales at like 1 or 2%. So I'd say it's probably got like a 3. Does it a defensive business model? Yeah, it's pretty defensive. It's regulated by everyone. It's got a pretty defensive business model. It's probably an 8. Is it a business you can understand? Yeah, it lends money out. It's in a competitive market, so on and so forth. You probably can't understand how it gets its money, how it prices its risk, all those types of things. But it's a business most people can understand. Does it have aligned management? Well, the management has been turned over a few times over the last 10 years, so it's probably not as aligned as the other businesses. But you could probably say they're well regulated, so let's say 2.5. You could say, does it have strong profit and cash flow? It's got strong profits. Does it have strong cash flow? It's hard to, you can't really use cash flow for a bank, but let's go 7. The only way you can really gauge cash flow is basically what is on the balance sheet and how much dividends are you paying. Is it a reasonable price? The way you value a bank is you base it off a dividend yield, or you base it off, the like price to book ratio. I'll give you a really quick crash course in a dividend discount model. This is how you value a bank. This is basically the value of a dividend. And what you say is you say the dividend payment, let me just see if I can get this right off the top of my head, divided by your required rate of return. This is me going back in my student days, minus the growth rate in dividends. That's how you do a valuation of a bank stock. So let's just break that down. Let's say you got a $1.67, I think it was, in dividends. And let's say your required rate of return is 10%, and the growth, you expect the dividend to keep growing at 3% a year in line with the profits of the business. So what we can do is we can say this divided by that minus this is a valuation of $23 a share. That's literally how you can do a dividend valuation model. It's called a DDM. And how does that compare to the share price? $28. So basically what you can say is the company's dividend has to grow faster than I think, or I have to lower my expectations of returns. That's literally it. That's a dividend discount model. Hope that makes sense. So we don't have time to do a full valuation, so I'll just go 2.5 here. And all of a sudden we can see it gets to a 30 in a competitive market. Finally, we're going to move on, and we're going to be quick. If you thought that was quick, we'll be quick with ARB. ARB sells bull bars and 4x4 accessories. ARB Corp, we'll jump back into the Tiger platform in just a second. It basically makes this happen with all the four-wheel drives. Everything that you can see is accessories for these different types of businesses. Its competitive advantage is that it's Australian made, or it's made in Asia. It sells products and services through its own store network, also through franchise network. And finally, it also sells in overseas markets, and it can sell directly through the car companies. Like, it's got a relationship with Ford. It's got a relationship with some other businesses like Toyota in the USA. And basically what it does is, its competitive advantage is that it can design the best bull bars for every car, every vehicle. They go on the front of SUVs and 4x4s. A way you can monitor its success in Australia is you can look at the number of cars that have been sold. I think this is a record number of cars sold in the year to October, of over 1 million already. So this is a huge, it's actually, number of car sales is actually growing quickly in Australia, which is quite impressive. But it's, where is its financials? It actually has a big business overseas as well. So let me go, here it is. And let me go down. And they present these lovely charts. It's a wonderful business named after Anthony Ronald Brown. That's the founder, ARB. And you can see growth rate has been slowing in recent year, in the last year, because the company says it's been supply chain bottlenecks and what have you. But if we see here, we see sales revenue over time. You see in the Australian aftermarket, so that's through like its store network and that type of thing, through original equipment manufacturers. This would be through the original sellers, so like the Fords and that of the world. And then we can see in the export market overseas, in all different types of places, it is selling product in Europe. I think it's in South Africa, Dubai, and the USA. So you can see it over time that has grown quite quickly over the past 10 years, although in recent years it has slowed down a bit. basically it's dependent on people still spending on full drives and people still buying cars and investing in it. So there's a cyclical element to it, but you can see it growing over time. Obviously, during COVID, everyone who couldn't leave Australia spent money on a caravan, a boat, or fitness equipment like a Peloton, and all of those things have now kind of fallen back down a bit. Dividends per share have been incredibly important for the business, fully franked. And one of the big reasons that its dividends have been so good is because the family behind the business are still running it. And they love dividends as much as anyone. It's a good way to get cash out of a business. And so you can see it there. The business is in a competitive environment. It competes against the likes of TJ, which is another business that competes in this space. But over time, it's been exceptional. We've got aligned management. It's in a growth-focused market, but it is quite cyclical. So I'll give it a 7 for long-term 10-year growth. Hopefully, if everyone goes to autonomous driving, they still need bull bars. So the defensive business model, not as defensive as the others. So I'll give it a 6 or a 5. Is it a business you can understand? Yes, it's pretty easy to understand. Does it have aligned management? Yes, I'll give it a 5. Does it have strong profit and cash flow? Yes. Although it does have an inventory cycle, so it means it needs to buy the materials to then make the products. Is it at a reasonable price? I think the share price has been sold down recently. Let's have a quick look. So we'll wait for this. I'm sorry I've had to rush through this one, guys. I ended up ranting about valuation for too long. And we look at do it again. Price to earnings ratio here. So you can see the company's valuation has fallen significantly since during COVID, when it was quite frothy, the valuation, and you can see how far it's fallen down. And price earnings ratio of 29 times with a dividend yield of 2% fully franked. Sales have fallen down recently, but the long-term trajectory seems to remain in place. So I'd actually say it's probably got the best valuation given its growth prospects at this limited stage. So far, we've come to the end of this session in terms of companies. You can see WiseTech is probably the highest quality. Feel free to disagree with me in the chat. Altium behind it, ARB, then NAB. But NAB is a different beast. It's a very mature business operating in a mature market. So it's actually a very defensive business because it's very hard to see a world in which NAB doesn't exist in the next 10 years. But these other companies could disappear and people would still be able to survive. If NAB went down tomorrow, click your fingers, snap your fingers just like that. If NAB went down tomorrow, we'd have much bigger problems than just the share price disappearing. It'd be much bigger problems. So in that sense, it is a very defensive business. I just want to check on some financials in the Tiger platform before I let you go. Actually, I might show you the other chart. So remember how I said there's a materials tab inside the Tiger platform? So for Mike and those that are probably new to this, this is what it looks like for fundamental research inside the Tiger platform. If we go here, we can see, I love this, how it breaks it down. This is the shareholder. We can see the summary of ARB. Look, it started in 1975. You can see all the news. You can see who owns the company. You can see like the Brown family, still massive shareholders in the business, even bigger than Australian Super or Vanguard in there. You can see the segments of the business. So you can see where it sells its products over time, how that's shifted and the mix has changed. You can see there everything above the line. It's changed over time. The different types of businesses and where it operates. There you go. Okay. Sorry, I just put that on screen. Tarwin, so is Tiger part owned by Chinese government? I don't know the answer to that question, Tarwin. I don't know. That's a good question. I would direct that to the service. You could actually probably check that by going. You could probably search the Tiger Brokers platform, Tarwin. You could probably have a look in here, and you can see part owned. There we go. So part owned. There we go. Very small shareholding by the look of it. And so, yeah, that probably answers your question there, mate. Okay, so we are at the end of today's session. So we're going to be back next week with the remaining elements of the Tiger series, the final installment of the Tiger series, in which we'll look at Amazon, Nvidia, Google, and Trade Desk, 4 fascinating US companies that we'll be looking at. Don't forget, you can take part in the giveaway that's up for grabs. All you've got to do to enter the draw is to fund your new Tiger account using the link that I supplied earlier. Everyone who signs up through Rask gets a special offer here. And good good on you, Chad. If you're watching this, you did win this week. So congrats to you, mate, and Michael last week. We'll be back same time next Thursday at 12 midday. Midday next Thursday. Check it out. Final installment of the Tiger Stock series. I really appreciate everyone coming live. And for the few hundred people that will watch back on replay, thank you for tuning in as well. Please write into us. Use the comments. I do read the comments every week, even if I don't respond to them straight away, because I like to answer your questions on these companies, because I love, even though I invest most of my money in ETFs and I want to do that longer term, I still love researching individual companies and finding out what makes great businesses like these ones tick. So thank you everyone who supplied some suggestions for the companies that we should follow, gave me feedback. Tarwin, Mike, everyone that rocked up Deepak today. Thank you for your time today, guys. Don't forget, you can find out more about Rask on the website. I'll be back next week to announce the last two winners, hopefully, of the Tiger Stocks giveaway. But bye for now. Have a wonderful week. Stay focused on the long term and get ready for Christmas. It's almost upon us, guys. So if you haven't got your presents sorted, make sure you get those Amazon orders soon, because who knows how delivery times will go. Thank you, Australia Post. All right, bye for now, guys.